Hi class, and welcome to this video for VCE Year 12 Economics, Unit 4 Outcome 2, which is all about aggregate supply. And in this video, we're going to think about the topic of tax reform, and specifically how does tax reform influence aggregate supply and how we can use tax reform to increase aggregate supply. You can see we're getting to the end of this outcome, and here we have the fourth key knowledge point, and we're going to focus here on the tax reform policies. Specifically, we're going to focus on how tax reform policies are designed to influence aggregate supply and living standards. Now, you might see that we talk about welfare reform in this key knowledge point. I'm going to do a specific video on that so we can split these topics up. So what do I mean by tax reform? And how can it influence aggregate supply? I always like to start these videos on aggregate supply to let us understand why we are doing this and what aggregate supply is. Aggregate supply is how much of goods and services are produced or supplied by businesses in that economy. We create a chart like this, and our aggregate demand is a downward sloping because as prices go up, demand will decrease for those goods. Aggregate supply is how much is being produced, and that will of course be influenced by the price. Higher prices, more being prepared to be supplied. Now, aggregate supply, the goal of aggregate supply policies is to shift the aggregate supply curve to the right, resulting in more being produced at every price point. And if we do this, as we know, we all have the benefit of a lowered price and an increase being supplied, an increase in GDP. Now, so clearly governments want to do this because it can increase our productive capacity, and tax reform is one of the mechanisms that government can use to increase it. The government can use and control the tax system to control aggregate demand. For example, cutting taxes will increase aggregate demand. But also, because this topic is about aggregate supply, governments can change and manipulate the tax system to achieve supply-side benefits that influence aggregate supply. So tax reform is all about how the government controls and manipulates the tax system, and we're going to think about how they can do that to influence aggregate supply. And an example that we've just talked about in a previous video and a previous key knowledge point are tax concessions for research and development. By providing that incentive for businesses to do research and development via tax concessions, so less tax, this will influence and hopefully motivate businesses to do research and development and come up with the next great idea, which will result in an increase in aggregate supply. So tax reform can often just be considered a way of changing the way budget revenue or budget receipts are collected. As an aggregate supply policy, as a way to increase aggregate supply, tax reform usually focuses on four ways to do this. They may reduce the tax burden through lower tax rates paid by individualized companies as a proportion of their income. They may review the tax base or coverage of inclusiveness to see what is being taxed and not taxed. They might improve the tax mix or a combination of different types of taxes used to raise revenue, so they'll look at the things that they are taxing. Or they might redirect how the tax revenue is raised is going to be used. But specifically, tax reform is all about changing the way the tax system works. And it's important because this is how the budget gets their revenue. So the government gets their taxes from lots of different ways. We know personal income tax is the biggest source of revenue, the next being often company tax, and then other ways such as GST and a few others bring billions of dollars into the government's coffers, which they can then spend. So how can a government manipulate and change this to incentivize an economy to increase the aggregate supply. In short, we are going to look at 4 key strategies or ways the tax reform taxes can be manipulated to create an environment where aggregate supply increases and our macroeconomic goals are achieved. We're going to look at tax concessions, rebates, accelerated depreciations or very specific tax reform method, and direct tax cuts. Hopefully by this you understand what these are, maybe get an understanding of what the government is considering or has done recently to influence aggregate supply, and we'll potentially think about some of the challenges of these as well. So when we talk about tax concessions are really allowances that allow a business to reduce their tax liability. It reduces how much they need to pay in tax. And we do this when businesses invest in specific activities or investments. So in short, tax concessions are a way a government says, if you invest in what we want you to invest, and typically these investments will increase aggregate supply, you can pay less tax. So you can see this is a powerful way that a government can influence resource allocation. So for example, a business that might be looking to expand in the export market might be given a tax concession. And the government is happy to do that because we want our businesses in Australia to be expanding overseas, because this will increase markets and increase potentially aggregate supply. Rebates work slightly different. They do work like tax concessions in a way, and they encourage investment in other activities as well. So I like to think of these as being very, very similar. And an example could be a research and development rebate, where you get a tax concession if a business does research and development. And we know if that comes good, a business will increase what they can be more efficient, more effective, increasing aggregate supply. Ones that you might not have considered is one called accelerated depreciation. This is for my accountants in the room, particularly those who are doing VCE accounting, which I also teach. We hopefully understand, even if it's through further maths, that accelerated depreciation is where a business recognizes their asset values are going down. They are using some of their benefit. Now, tax reform has allowed businesses to accelerate that depreciation, make the depreciation more in the initial lives of that asset. Now you're going, why is telling a business that you can say that we've reduced the value of that asset going to be a benefit? The key bit here, as an accountant, I know that depreciation is an expense. And expenses reduce profit, because profit equals revenue minus expenses. And hence, if we allow businesses to have more expenses because of more depreciation, they will report less profits. And you're going, why would a business want to have less profit? Businesses pay tax on their profit. So essentially, businesses being able to have more depreciation will be paying more tax. And we're happy to do this because purchases of technology increase the efficiency of an economy, particularly the technical efficiency. So for example, in the 2021 budget, it was announced that businesses with turnover up to 5 billion could depreciate the full value of their asset in the year of the purchase. So in a sense, the full purchase price became an expense that reduced profit in that year. So a bit of a technical one. A more easier one to understand and a more direct way to increase aggregate supply is to do a direct tax cut. A more direct way because it addresses everyone. It often impacts everyone. And it involves typically reducing a specific tax rate, like a company tax or income tax. And we're going to talk about those two in a minute because these are two ones that are happening at the moment to increase aggregate supply. These are generally more permanent and not as tailored or specific like tax concessions and rebates, which I would say are more tailored to a particular investment or a particular industry or investment, whereas direct cuts often impact everyone. So what are some of the things that have been happening in terms of direct tax cuts. And why are direct tax cuts such an important way to increase aggregate supply? If businesses and people are paying less tax, they are going to be able to produce more, demand more, and that will increase the economy size. So, company tax cuts have been occurring because historically, businesses would pay 30% of every dollar of profit as tax. However, the tax rate for those businesses that earn $50 million or less is going to be reducing to 25% from 30%. So these businesses, all businesses that earn below $50 million, which is a lot, will be paying 5% less in their tax rate, 5% less tax. And that's important. Will not be paying 5% less tax. They'll be paying even more than that because their tax rate will reduce from 30 to 25%. So if a business is paying less tax, they will be able to spend more money on investments, on hiring, and this will increase aggregate supply. Personal income tax cuts are also going to be coming into phase, where particularly pretty much everyone across in Australia will be paying less tax, and it is thought that will hopefully increase aggregate demand, but also help with aggregate supply. Now, the key bit to understand, and we're not going to go through all of this, but I thought it's interesting information to have, is that tax reform is complicated and challenging. The tax system in Australia is complicated. So there has been a number of reviews. In 2010, there was something called the Henry Review, which made 138 recommendations, including doing things like cutting the tax rate for company tax. But very few of these have been implemented because doing tax reform is challenging and complicated. And you can see some of the things that they recommended, and very few of them have been implemented. Not only that, in 2015, a similar review was done in the Think Better, Tax Better Australia discussion paper. And if you pause this, you'll see that some of their recommendations, not all of these have been implemented, but what a general intention that tax reform should do, and it was talked about there, said that we should be having taxes that are lower, simpler and fairer, increase incentives for effort. So we want businesses and individuals to not feel overtaxed, so they put effort in. And we want to create a tax system that supports efficiency. And if we do those things, aggregate supply should increase. Now, specifically, I'm going to go through all of this. Reforms involving tax reforms should help us achieve our macroeconomic goals. Tax reforms should and have helped us slow inflation. As lower rates of personal income tax increase disposable incomes, which might help slow demands for higher wages. So if you have more money because you're paying less tax, you might not be demanding higher wages. Lower company tax rates allow firms to gain stronger after-tax profits, so they don't have to increase their prices to increase their profits because they're just keeping more of the after-tax profit. And things like lower tariffs and the abolition of other tax like carbon tax and those sorts of things have increased the profits of their businesses. So in summary, lower taxes will mean that people will have more money in their pocket, so they won't need to be asking for high wages, which is inflationary. And businesses paying less tax will feel like they are getting to keep more of their profit, and hence they won't need to raise their prices to chase higher profits. Also, tax reforms can help with achieving strong and sustainable economic growth, because lower personal income tax rates can create greater rewards or greater incentives and motivate people to work harder, to work longer and gain promotions because they get to keep more of that reward. And this will hopefully drive GDP. Cutting tax rates also disincentivizes businesses to invest and expand, and this can also increase GDP and capacity as well. And I encourage you to pause this video and read a little bit more of this information, but I'm just summarizing because I don't want these videos to go for too long. Also, lower tax rates can help us achieve strong and full employment, as lower tax rates can strengthen and incentivize to get work and get a job because you're going to get to keep more of the money. And in addition, lowering company tax rates for businesses will improve their profits and allow them to hire more people and also invest in their people to potentially cut structural unemployment. So again, cutting tax rates theoretically will help us achieve strong and full employment. So I hope that you found this video useful. I've skipped over some and I encourage you to pause that or go back to make your notes, but I hope that this has given you an insight of how tax reform can influence aggregate supply, help us achieve our macroeconomic goals and living standards, and got an understanding of some of the tax reform tactics, such as concessions, rebates, direct tax cuts, and the specific one of accelerated depreciation.